In 2025, everything about your money feels like a news headline. At least it does to me. We're talking tariffs on imports or fueling inflation, slowing job growth. Matter of fact, I believe I read an article just this week that said consumer confidence has taken a nosedive after weak jobs data has been released. And of course, we all know about AI-related tech stocks, much of which have been driving the performance of the S&P 500, or at least the general market's gains. The biggest hot topic, I guess, for the year, headline, well, Congress has been doing a little bit of work, rewriting the tax code. Yeah, the One Big Beautiful Act, One Big Beautiful Bill, a law that permanently extends the Tax Cuts and Jobs Act standard deduction. It's going to add tax breaks for overtime, tips, car loans, and seniors, which we all know Trump was pretty motivated about. Look, if you're like most high-income earners, you're probably wondering the same thing that we hear every day, and that is, how in the world do I keep my retirement savings on track with all these moving parts? How do I ensure that everything that I'm doing, from the money I make to how I save to where I save it, the risk that I'm taking, is actually heading in a direction that I desire, taking me to the place where I want to go financially, financial freedom? Well, you're in the right spot. Welcome back to Asset Management Group's podcast. I'm Andrew Nida, and we're here to talk about a financial benefit that you're offered to ensure that we turn that into an actual strategy. We're going to fix your 401k. You're going to learn why two people with identical paychecks can end up with radically different retirements. The 3 moves you need to make, literally this week, and how the latest economic news and tax law changes will affect your plan, should affect your plan. 2025 updates, well, we're going to cover that as well. So I want you to stay tuned. More importantly, before we jump in, if you've never listened to any of our podcast shows or any of our educational videos, take some time, work through it, like our show, follow us so that you get great content just like this every single week. All right, let's jump in. Now, before we talk strategy, let's quickly run through the numbers on policies that you need to know. Some recent changes, big, beautiful bill, that's going to allow you to consider additional savings for better tax benefit. In 2025, you can contribute $23,500 to your 401k. Now, that's a pretty good bit of money. And if you're 50 or older, you get this new standard catch-up of $7,500. Now, those numbers typically inflate a little bit every year. There's also now a special catch-up of $11,250 for people ages 60 to 63. Combined with employer contributions and any after-tax savings, check this out, listen, the total plan limit, $70,000. That's how much you can put back. Another new change is this auto-enrollment that we're going to break down in escalation. Under the Secure Act of 2.0, new 401k plans must auto-enroll employees no less than 3%. And they have to also ensure that you're set up to auto-escalate, meaning that your contributions will increase by 1% each year. Now, those are defaults and rules with the Secure Act, but it's not necessarily the recommendation. It's not the finish line. We got to figure out what's best for you. Here's another change: long-term part-time eligibility. Starting in 2025, part-time employees who work at least 500 hours per year for 2 consecutive years are eligible to contribute. And the One Big Beautiful Bill, there is so much in that tax law and policy that needs to be understood well. We can't go through all the details in this video, but just a few things to keep in mind. The law makes the Tax Cuts and Jobs Act standard deduction permanent and increases it. Right now, we're at $15,750 for single filers, $31,500 for married filing joint. It also allows workers to deduct up to $12,500 of overtime pay, double that for joint filers, and up to $25,000 of tips from taxable income, which by all means should be tax-free, and that's a nice deduction. You want to make sure you take advantage of it. It does phase out for higher earners, though. Now, there's a deduction of up to $10,000 for interest on car loans for vehicles, check this out, assembled in the U.S. If IKEA made a vehicle, you could assemble it, maybe get the interest deductible. That's a joke, by the way. Seniors 65 plus get an extra deduction of up to $12,000 on top of the standard deduction. Let me just pause here real quick and say our firm is highly focused and engaged on tax strategy. And what I will tell you is, after already running through some tax plans for our clients, yes, Social Security is not fully tax-free, but this extra $12,000 deduction is a huge benefit, huge. And then economic backdrop. Tariffs are causing price spikes, supply chain disruption, pushing inflation above the Fed's 2% target. Jerome Powell, not a best friend of Donald Trump. We got interest rates changing as early as potentially next month. By the time you watch this video, we may already see the evidence of a rate cut. At least it's baked in right now, 85% or more. Now, job growth has slowed to about 85,000 jobs per month. Consumer confidence is slipping, and interest rates may be cut later this year, as I mentioned, as early as September. And they're going to do it to stimulate growth, increasing available jobs in the market. Meanwhile, the S&P 500 is not struggling. It's up somewhere around double digits or right shy of double digits, at least it has been at this current moment, driven predominantly by large cap companies and AI-focused organizations. Now, these updates aren't just trivia. They shape how you should manage your retirement contribution, what type of risk you should be taking, where you should be saving. Do you have a tax strategy? Do you have a financial strategy? Do you have a plan at all? You work 40 hours a week, however much that is a year, plus make sure that you're not working for free and just giving money to the IRS. Let's make sure that we're mindful about how we're saving to ensure that it benefits you. So why do identical paychecks lead to just wildly different retirements? It's not just because of the market, although it matters. Oftentimes it's the defaults. The little silent, subtle things that are happening within the plan that's making you get behind. All right, so check this out. This one's subtle, quiet, doesn't affect everybody, but it's the tiny settings in your 401k. The quiet reset, if you will, every time you have a job change or your company changes 401k providers. Many new hirees are auto-enrolled at 3%, and they just simply forget to adjust it. You may have been there. If you swap employers, you get a new plan, you forget once you become eligible to participate in the plan, and then all of a sudden, you find yourself contributing at a rate much less than what you have in years past, costing you a lot of money. One analysis suggests the reset drag, meaning I've been reset to 3% and haven't made the adjustment, can cost upwards of $300,000 in lost savings, just simply because you didn't take the time to go and make sure that you were putting in the 401k what you expected, getting the match, and making sure that it's increasing every year. Now, here's a real-world example. Let's take Maya. Now, Maya earns $200,000 and has been contributing 12% at her old job. Here's the example. Her employer goes with a new plan. Her existing 401k stays within the plan, but she didn't know that they were going to reset her contributions to 3%. That's the standard for a safe harbor plan. 9 months later, she gets her paycheck and she says, you know what? I'm not even close to maxing out my 401k this year. And at that point, she's undersaved 9% of her salary. She's missed 2 quarters of employer matching in contributions and years of compounded growth. A 5-figure hit before the power of compounding over time. Yeah, she jumps in there and fixes it in a matter of a few minutes, bumping her contribution back up to 12%, adding a 1% auto escalation to get her back up toward that 15% over time, mixing the correct pre-tax and Roth contribution diversification. I'm going to come back to that a little bit later. Turning on after-tax contributions within the plan, doing Roth conversions, and scheduling a quarterly reminder. Now, how many people do that? But we're going to give prompts to Maya. She did it. Now, that small reset, though, the 9 months that she went without contributing or contributing less than she expected, we're talking 6 figures over her lifetime, assuming that that event happened 15 years or more before her retirement. Here's the point. Do not let a 3% default write a 6-figure chapter of your retirement. Make sure you're saving the way that you expect relative to your income. Make sure that you're challenging your ability to increase your savings each and every year. Here's 3 moves you should make. I'm talking this week. Set the right contribution rate and lock in escalation. Everybody forgets to do that. They don't force themselves to increase the contribution when in all reality, if you set an auto escalate at 1%, you're not going to know. Look, the coffee you buy in the morning at Starbucks, the quick stop to pick up a biscuit before you go to work, when you leave work a little bit early and stop at the gas station to get yourself an energy drink. All of that is going up much greater than 1% every year. You keep buying it. The least you can do is make sure that your savings go up at least 1%. Many large plan providers, they show that a total rate of around 14 to 15% of saving deliver a solid retirement trajectory. We're going back to like the old Dave Ramsey day. Okay, Dave Ramsey used to preach, 15% of income? Now, I get it. Some of you guys may not be able to start there, but it doesn't mean you can't get there. Set that escalation rate so that you can push yourself to get to 15% of gross income. If your employer match is 4 to 5%, by all means, I don't care what it takes, you have to do that. It's free money. You have to capture the employer match. Then you can set the auto escalation if that's your starting point and increase it year over year until you hit your target. If you just change jobs, restore your old contributions. Don't tell yourself, I'm going to wait and kind of get settled in and just figure it out. Go ahead and do it. Like, knock it out. And your default should not be the minimum. You should be pressing yourself to continue to save. I'm not saying you can't live today, but definitely do something so you can live the life you live today later. Number 2, choose your tax lane on purpose. Pre-tax versus Roth. This is important. Maybe one of the most important things. In high inflation, high tax environments like 2025, tax planning matters. It matters a lot. I'm going to give you just a few rules to consider, but I will tell you right out of the gate, you need to make sure you have a tax plan. I don't care if you make $150,000 a year household income or $1 million a year in household income. You have to have a strategy. These laws are out there. Policy is intended to be embraced and to be used. We just don't have the time or take enough time to go and, consider all the different policies that could improve our tax story if we just played the game. If you're sitting there and you're in a very high tax bracket right now, and you expect to have lower taxes in retirement, you should consider pre-tax contributions. That's pretty simple. The problem is a lot of people are not in a lower tax rate environment later. But if you can get a deduction now, consider it. It could offset some inflation-driven costs, and you could get that compound growth on money that otherwise you'd have gave to the IRS. If you expect higher taxes later or want diversification, then allocate more to the Roth. Consider even a backdoor Roth or a mega backdoor Roth. Look, the Secure Act 2.0, let me start that over, made Roth options more available. Most retirement plans, not all, most, now have the option to participate in a Roth 401k. Some even allow the employer match to be treated as Roth contribution. And that's incredible. Number 3, use back pocket upgrades. Look, if your plan allows this is incredible. We're talking beyond the standard contribution that you know of in a 401k, what I've already talked about. We're talking about after-tax 401k contribution within the plan and doing a plan conversion, a Roth conversion. This is called a mega backdoor Roth. Look, the mega backdoor Roth lets you push your total contribution to that $70,000 plan limit. You don't have to do it all, but you can do up to $70,000. Then you can convert after-tax money into a Roth, giving more tax-free wealth. If you're a high-income earner, you're probably thinking, hey, I can't contribute to a Roth. I make too much money. Yeah, you can't contribute directly to an individual Roth IRA. Maybe you should consider a backdoor Roth if you don't have traditional IRA money already. But we're talking about the 401k. There's no income limitation on a 401k. And yes, you can contribute to the 401k, then max fund the post-tax piece of your 401k, convert it on the back end. We're talking significant tax-free wealth compounding over time, legacy change financially. And then if you're 60 to 63, why are you not taking advantage of the $11,250 extra limit that you can contribute this year? If available, elect to have your employer match treated as a Roth. If it makes sense to your plan, get as much money in a tax-free position. It's going to turbocharge your growth. If you haven't been able to fund a Roth, many of you guys already 55, 60, 65 years old, use the catch-up as an option to fuel the tax-free accounts that you didn't have available when you were in your 20s and 30s. Now, these features will transform the old plain Jane 401k really into a high-power, tax-efficient machine. And that's exactly what you need. You need to get your money working for you in the way that makes sense. Many of you guys save a lot of money. We're talking about how to save correctly to increase tax efficiency for your future. Now, let's talk about integrating this OBBBA, tax breaks and economic trends, in your plan. Yeah, that's OBBBA, the One Big Beautiful Bill. This act offers new deductions that really could free up cash flow a lot and give you extra money to fund your 401k. If you earn tips or overtime, you're able to deduct up to $25,000 of tips and $12,500 for overtime pay, and you can double that for couples if your taxable income falls within the threshold. If you're a senior, you get an extra $12,500 deduction. I mean, that's huge. And there's a deduction of up to $10,000 on the interest you pay on U.S. assembled vehicles. If you take advantage of these deductions, consider redirecting some of those tax savings into your 401k. Make the adjustments, see what the net impact looks like on your pay stub, and then go back and make the change. Don't just absorb the extra income like we typically do, spending more money where we don't need to spend it, and then expecting a life that we won't be able to live. Remember, we're heading into a period where tariffs and inflation, well, I mean, it could erode purchasing power for sure. We're definitely probably going to see rate cuts, as I've already mentioned, as early as maybe the month of September. A lot of this could boost bond prices and create some economic uncertainty. Investing consistently and capturing every match dollar is going to be incredibly important. Having an investment strategy that you can stick with is going to be the key. Don't jump in and out because you're nervous. Everybody that we have ever worked for that is in a position where they have decided to override the guidance and advice, jump into cash, whether it was because of COVID, because of the start of 2022, the battle between Russia and Ukraine, whether it was the election of 2025, it doesn't matter. Regardless, every one of those has missed out on significant opportunity. You got to have an investment strategy you can stay consistent with, taking risk in the right areas. Now, I want to talk to you real quick about common money leaks and what you need to do to make sure the leak stops. Number one, we're not going to leave the match on the table anymore. If the employer matches average 4 to 5%, missing even a few pay periods is like refusing free money. It's silly, okay? Check the matching formula and backfill if it's allowed. This 4 to 5% match or whatever you're getting has to be taken advantage of. If you have to, stop going to Starbucks, stop going out to eat, stop putting your kids on 3 different travel teams. Do whatever it takes. Get the 4 to 5% match. There's nothing else out there that's going to double your money as soon as you make a deposit. Do it. It's vitally important to your success. Now, sticking at 3%, got to get away from it. We've already talked about it. I've hammered in. Get away from the default. Let's increase your contribution. Don't get stuck with the standard. You're not standard. Let's increase those contributions. Let's get and make our way to that 10 to 15% contribution of your income. Job change amnesia, it's out. Each time you switch your jobs or your company resets the plan, you're going to reset your contributions and you're going to challenge yourself every single year to ensure that you're on the right path and you're saving the right amount of money from your income. Now, here's a 60-second setup, something I want you to do literally tonight. Log into your 401k plan. Check your contribution rate. Set your employee rate high enough to capture the full match at minimum. If you're already contributing, go ahead and make an increase of 1%. Remember, we're shooting for 14 to 15%. Now, that's a rule of thumb. Schedule that 1% auto increase. If you have plenty of disposable income, do it every quarter until you get to 15%. Pick your tax lane, pre-tax, Roth, or a mix, and revisit your choice annually. Now, I wish I could tell you which one to do, but the tax decision is dependent on your story, what type of diversification you have, where you're headed, and how much you've already saved and what you're earning. So if you don't know, just ask. We can help you out. Lastly, check for after-tax contributions. This mega backdoor Roth is not taken advantage of as it should. You can complete Roth conversions within your plan. Doesn't matter if you're 30 years old, 65 years old. You need to see if it's an option. Map out contributions if you have the ability to approach that $70,000 limit. Take advantage of any age-based catch-ups and consider that mega backdoor Roth conversion. If you qualify for the big, beautiful bill tax deductions that we've talked about in this show, tips, overtime, car loan, interest, senior deductions, adjust your withholdings so that the extra cash flow isn't going to just create a bigger tax return. The goal here is not tax returns. The goal here is tax-free wealth. The goal here is making sure that your money is working for you. Now, bottom line, here's the key. Your 401k is no longer a set it and forget it benefit. Think about it. You guys are working literally 40 plus hours a week. You're working every week of the year, getting a vacation for a few weeks. 25-30% of your income is going to the IRS. Literally. That means 25 to 30% of the time you invest, literally the first day and a half of the week or more, is being given away. Why are we not taking time to think about what the government is getting? You got to do your best to keep it for yourself. We're facing a new chapter when it comes to tax laws, enrollment rules, contribution limits, volatile markets, AI technology, tariffs, new leadership. We need to make sure that we're aware enough to play the game on your home field, the game that's going to benefit you and your family the most. By raising contribution rates, choosing the right tax lane, and using advanced features, you can turn those benefits into a powerful retirement strategy. If this video helped you, absolutely like the video, subscribe to our weekly High Earner Playbook, and share it with a few friends. Our goal is to ensure that everybody, every individual just like you, has the right information to make the right decision for their future. After all, the keys are in your hands. You got to use them. You got to make sure that you're pointing in the right direction. If you don't know, we can help. Drop your comments right here. We read every single one of them. You got questions? Reach out. More importantly, make sure that every bit of the time you spend is for you and your family. Think through all that you're doing to ensure that the direction you're headed is the direction you want to go. And if you need help, we're here. Don't hesitate to reach out. See you next week.